Welcome to Personal Finance 101. In today's show, in today's video, we're going to talk about the mortgage rates. We are in January 2024, the end of the week of between the 15th to the 19th of January 2024, and the mortgage rates fell to the lowest level they have been since May 2023. Freddie Mac published the rates and showed that it's 6.60%, 6.60%, the lowest it has been since May 2023. Interest rates dropped. It's a good sign. That means real estate will be moving again in the year 2024. Is it a good time for you to buy a house? How do you understand the mortgage system? When does the rates go down? Can I lock my rate? If I'm buying a house, how much will my mortgage payment be? Is interest rate and APR, annual percentage rate, is the same thing? What is a DTI, which is a debt to income ratio? How could you understand why, if I have a 600 credit score, I got a higher rate compared to somebody that has an 800 credit score? What is an FHA rate? What is a conventional rate? What are the differences between a 15-year rate mortgage and a 30-year rate mortgage? How much total interest do I pay when I got a 30-year rate? Why my payment got changed between the principal and interest depends on what year I am in my mortgage. All these questions will be answered in today's video. But what matters the most is the rate dropped at 6.60%, the lowest it has been since May 2023. My name is Frantz Devilme. I'm a real estate broker. I can help you sell your house or buy your house today. If this is the first time you're listening to us, consider subscribe to our show. You click the link below, you click the subscribe below, you click the thumbs up. That will help our channel on YouTube. We are not a mortgage broker, we are a real estate broker. We are providing you information about real estate in general. Thank you for listening. Keep listening to us and stay till the end of the show. You will learn a lot today about mortgages in general. Every aspect of a mortgage, you'll be able to understand the general idea if you listen to our show today. Thank you. The mortgage rates went down. They were 6.66%. They went down to 6.60%. The highest they've been in the year 2023 was 7.79%. Also, the lowest they have been was in January 2021, where the interest rate for a mortgage, 30-year fix, went down to 2.65%. That was 3 years ago. So basically, what is a mortgage, right? A mortgage is basically money that you borrow from a financial institution or from a bank in order for you to purchase a property. Because today we're talking about real estate, mortgage for real estate. So let's say you're buying a $400,000 house and you only have $40,000, 10%, or you only have $80,000, 20% off the $400 off the purchase price. You need to come with the difference, which is the $320,000, 80% of $400,000, and that's called a mortgage. Where will you get that? You're going to get it from a bank or from a financial institution. That financial institution lending you that money will put a mortgage on that property that you're buying. Just in case you don't pay them, just in case something happens, they can repossess that property. The bank is in the business of making money by lending you $320,000. They will charge you an interest rate and they will charge you some other fees in order for them to make money, to make a profit out of that money they're lending you. The total fees plus the interest rate together is called an APR, annual percentage rate. So the interest rate is basically the rate by itself that they charge you towards the mortgage. And when you're adding it to other fees they charge you, all together combined make what they call an APR, annual percentage rate. The rate today, 6.60% on a 30-year fix. That rate doesn't guarantee you that you're going to get it. Now, it depends on different things about your income, your job, your credit score, different other things that we're going to talk about in a few. Basically, after you get a mortgage, they give you something they call an amortization schedule that shows you amount of payment, principal, interest. Because basically your payment of your mortgage is divided into 4 different items. But today we're going to talk mostly about 2. The 4 items are PITI, principal, interest, taxes, insurance. The 2 we're going to talk about the most today are PI, principal, interest. At the beginning of the loan, your interests are higher, your principal are lower. They do that on purpose because the bank wants to make their money within the first 5 to 7 years of the loan. The majority of the people, when they buy a house, within 10 years, they resell it. And if you do that, the bank make more money because the bank charge you more interest in the first 5 to 7 years of the loan. So if you keep flipping, buy a house, pay mortgage, resell it, buy another one, get another mortgage, well, it's good for you if you make money, don't get me wrong. But the bank makes more money because they make a big chunk of the interest rate at the beginning of the loan. So what determines the interest rate that your bank's going to charge you? It varies, as I said earlier. Now I'm going to go in detail for you to understand better. If you have a W-2 job, so that means you work getting paid every week or every 2 weeks, banks loves that. If you got a credit score which is higher than a 690 or 720, banks loves you. If you have the down payment, which is either 5%, depends on the bank, depends on the program, or 20% down, so that means you're not going to have to pay private mortgage insurance, which is PMI, is better for you. There are different situations, there's not anything straight about this is better than this. Every scenario has advantages and disadvantages. So if you have a W-2 job, you've been working for more than 2 years in the same field, you fill your income tax regularly, you can show W-2, you got a low debt to income ratio, bank loves you. And in that case, they're going to try to get you the best possible interest rate. But that will depend on a few things. The type of property you're buying, is it a condominium, a townhouse, or a single family? Location of the property, how old the property is that your primary residence or investment property? What is the type of loan? Is it an FHA or conventional? What is the loan term? Is it a 15 years or a 30 year? What is the loan to value? Is it a 95% loan to value where you only put 5% down and the bank lend you 95%? Or is it a 20% down where you put 20% and the bank lend you 80%? Are you putting 30% and the bank lend you 70%? The more you put down, the lower the risk is for the bank. And the bank really love to lower their risk. There are different type of mortgages. You can get 10 years, 15 years, 20 years, 25 years, or 30 years. But the most common mortgage term are either 15-year fixed rate or 30-year fixed rate. The 15-year fixed rate, we're going to give you examples today of if you got a mortgage of $300,000, interest rate at 6.29%. For a 15-year fixed rate, your monthly payment will be $2,579. The total interest charges you're going to have to pay is $164,186. And the total loan amount will be $464,186. The 30-year fixed rate at the same loan amount of $300,000, the interest rate will be higher, 6.89, monthly payment $1,974, total interest $410,566, and the loan amount is of course $300,000 plus 410. That gives you $710,000. They always do it like that because on a 30-year mortgage, you pay a longer period of time, so the interest rate is higher and your payment is lower. What are the pros and cons of mortgages? If you are thinking about taking a mortgage, here are some benefits to consider. Those are the pros, the advantages, the benefits to get a mortgage. First of all, it's predictable monthly payment. We're only talking about the principal and interest. A fixed rate mortgage loans, it comes with an interest rate fix that does not change over the time of the loan. So if the loan term is 30 years, for 30 years you're going to have the exact same principal and interest payment. So that means more consistent payment that allow you to do a budget, balance your budget better. We're talking only principal and interest. Potentially low interest rates because you have a longer term loan. The bank encourage you. Potentially you get a low interest rates. With a good credit score and a high down payment, you could get a competitive interest rate. Adjustable rate mortgage may also come with a lower initial interest rate than the fixed rate mortgage. We don't really recommend to get an adjustable rate, but everybody's situation is different. You may consider an adjustable because it's lower than the fixed, but for the fixed, you're more stable. Potential assets. Real estate is often considered an asset. As you pay down your loan, you can also build home equity, which you can use for other things. If you got credit card debts, if you got other expenses you want to do for your home, you can pull that money in a line of credit to do either what they call debt consolidation or home improvement projects. Some biggest downside of getting a mortgage is expensive fees and interest. Long-term debt, 15, 20, 30 years. And if you get an adjustable rate, the rate may change on you. How do the bank basically decide how to get your rate? And we mentioned it before. First one is employment. Second one is credit score. Third one is DTI, debt to income ratio. Fourth is how long has you been employed. Fifth is the property type. Sixth is the loan type. Are you going for FHA or conventional? Down payment. And finally, the type of property. We covered today a lot of things that have to do with your mortgage. We hope that you really now have a good idea about what a mortgage rate is. How do they charge your mortgage rate? Care about your credit? Pay your bill on time so you keep your credit in good standing. So the day when you're going to be ready to buy that property, your credit score won't affect you that much. If you pay your bill on time, you lower the amount of debt that you got on that credit. Meaning if you have a credit card that has $10,000, you try to keep it lower than $2,000, lower than 20% balance all the time. You pay, the best idea is to pay all your credit cards in full every month. But if you cannot do that, try to keep the balance lower than 20%. Mortgage rate is as low as it's been for the past 12 months. It's at 6.6% today for a 30-year fix. Will that impact the mortgage rates? Will that mean that you be able to get a cheaper house? We doubt it. Interest rate keep moving, and we're hoping at the end of this year, 2024, it will be in the low 6% or lower than 6%, in the high 5%. That will create an encouragement for all the buyers to come in the market and try to buy. If there's low inventory, how the same way we have it today, we're going to have the same problem again. So we hope that we'll have high inventory If we have a high inventory and a low interest rate, it will be great for the buyers. But if we don't have inventory and the rates are low, buyers will be fighting. It's like you have 100 buyers fighting for 20 houses, prices will still go up. Only the future will help us understand if the real estate market will go down in prices, or if it will stay the same, or if it will go up. We don't have that answer. Only the future will tell us. If you need more advice, if you need consultation, if you need more information about mortgage, real estate, finance, investments, you can reach out to us. Our number is down below the screen. Our email address is down below the screen. We'll be glad to help you. My name is Frantz. I'm a real estate broker. I've been doing this for 28 years now. Real estate is in my blood. I love real estate, and I'll be glad to help you, assist you in any type of real estate transaction that you're doing. Thank you so much. Remember to subscribe and to like our page. Thank you.